The U.S. Treasury yield curve. In this video, I'll discuss what the yield curve is, how it can be used to hedge risk and predict potential recessions, and how to create your own in Google Sheets using FMP. A yield curve describes the unusual drop of yields on longer-term debt below yields of short-term debt. This means that an inverted curve occurs when short-term debt instruments have higher yields than long-term debt. And this is what the inversion looks like. A normal distribution or curve looks like this. So is it reliable? JP Morgan talks about it here. Now this is an article from 2018. Every time that we have an inversion, a subsequent recession occurs. So back here in the late 80s, yield curve inversion, recession followed in gray. Yield curve inversion right around the dot-com bubble popping, yield curve inverted, recession. Same thing with 06 to 08. And then this graph doesn't show it, but in 2020, the yield curve inverted again. We had the recession that we just got out of, and we're now inverted again, and we're likely going to see another recession here in 2022 to 2024. So this can be useful in your own portfolio because when this inversion happens, you're likely going to see the stock market go down, and you're likely going to see the Fed step in at some point, conduct QE, and then pump the market back up. So back to Google Sheets, let's start a new sheet. The issue here is that you won't be able to use FMP's add-on in Google Sheets to call on this data. Instead, we have to use JSON. So to do that, the first thing we're going to need is our API key. So to get that, we can go back to documentation in FMP and your details. So we'll grab our API key and we'll drop that into cell B1. Next, we're going to need some dates. And so in E1, we're going to do equals to date, and we'll do today, close parentheses, because we're going to need a to and a from to bracket what dates we're looking to pull. And then in F1, we're going to go equals to date. We're going to use workday, today, close parentheses, and we're going to do minus 150 days to today. And this will just give us a range that we can then use as we're trying to pull the data over the past 90 days. And now we're not able to just use this data in its raw form. We have to convert it to text so that Google Sheets and JSON can read it properly. So here we'll go equals text. We'll go back to cell E1, comma, and in quotes, because we need this in a certain format, equals, that's our year, our month, and our date. Quote, and then we can drag this over. So this is to date. This is text. Okay, center these. Next, we'll save space for our distribution. If it's normal or if it's inverted, we'll leave that there. Now we have to bring in our scripts so that we can enable our delayed JSON. So to do that, we need to go extensions, app scripts, and the first one we're going to create will be a script. We're going to call this one DelayedImportJSON. Control A, delete all that, and we'll put our formula in. This I'll leave in the description, and you can just copy and paste it. Okay, so that's our first one. We'll hit save. The second one we need is going to be found at GitHub, and this is it. And we're going to copy all of this, and we're going to paste it in. So we can go to raw, Control A, Control C, go back to our project, and we're going to do another script. We're going to call this one ImportJSON. Delete everything that's there, and then drop our script in. We'll hit Save Project. Okay, now that JSON's enabled, we'll go to cell B6. To save time, I'm just going to paste it in here. But what we're grabbing here is we're going delayed JSON to text. We're pulling from FMP's API on the web, and it's from F2 to E2 using API key B1. We don't have the ability to pull Treasury data on the Google Sheets add-on, so we had to go back to our documentation. If you Control F, Treasuries, this is what we're pulling from here. And here we can get all the data for every maturity. Now that we have our data, we need to convert everything to percentages. So we'll start with C5 and go equals C7 divided by 100. Make this a percentage. Take this box, the 30-year. Good. Okay, and then we'll go to the bottom, go down here. We'll go equals. We're going to use this data at the bottom to create our chart. We'll grab C6, pull that over. We're going to want the current rate, 30-day, and the 60 days so we can see the change over time. So in this cell, we're going to grab C7, divide by 100, make it a percentage. And we can do the same with a 30-day. And in this case, we need cell C27, divide that by 100, and we need 47. Divide that by 100. Okay, make it a percentage. You can grab all these boxes, pull them over. Boom, we have our data. Okay, we can go back to the top to give us signals for if the inversion has occurred or not. So equals if D5 is less than the preceding maturity, then inverted, and if not, normal distribution. Grab this, drag it to the end, and you can see we already have some inverted signals. We can highlight these, conditional formatting. If text is exactly inverted, we'll make that highlight red and bold. And then we can come up here, merge these cells. This will be inversions, enter, make it 14, bold. We'll merge these as well. We're going to count if, in this range, we see the word inverted. And if that's true, it'll return quantity, which is 5 in this case. So we have 5 inversions. We can do another conditional formatting. And if the number is greater than 0, I would like to be alerted of that, which means we have an inversion. Okay, that's our raw data. Now let's go and make a graph out of this. So here we can highlight this data down here, go insert chart, and our chart type is going to be a line chart. And we can go into customize our theme. We can make Roboto. We can call this US Treasury yield curve. For our series, we can select the current, and we want to see those points, see the labels on it. For the 30-day, we can make this green, and our 60 can remain orange. That's fine. Okay, and you can move this around wherever you like. What I prefer to do is to make it its own sheet. And just looking at it, yep, we have an inversion. So we have the 1 year at 3.16%, which is above the 2 year. We're tied with the 3 year. The 1 year is inverted to the 5, the 7, and the 10. So this is a pretty big inversion. So this is abnormal, and this will give us a signal of a potential recession. So we can use this to hedge risk, to position size accordingly, and to decide when we might want to get back into the market if we're sitting out at this moment. I hope this helped, and if you have any questions, please reach out. Please let me know if you'd like me to cover anything else. I appreciate it. Thank you. Bye.